Well, it's another day, another Naira, another day to wrestle Mr. Market to try and rip out some profits in this market. It's definitely not easy, but, keep your eyes on business morning and somehow you get some direction and get some profit out of these markets. Let's flip over now and see what's playing out right there. We're seeing oil prices, still the star right now, but it's back on the rise again. Brent crude, $105 per barrel, 2.71%. Definitely for government revenue, you get excited about that. But when you remember what's happening at the pumps, you get sad, at this point. WTI crude, 92, 93, 2.91% higher. And we're seeing Iran, reviewing proposals from the U.S. and also putting out, their proposal at this point. And, market participants, signaling. I'm looking at what's playing out right now with, the negotiations and saying, okay, you know what, they're seeing volatility at this point, and they're putting a premium right there. The risk is back on in the oil market, and definitely there's that inverse relationship between oil and global indexes. So they might be dropping, at this point, but who knows? They might find a way to, shrug this off, at this point. But oil is back up. We'll see what happens to gold later on. And back here for the local bourse, we see the NGX did close on a positive note yesterday, with the all-share index gaining nearly 220 points to settle above the critical 200,000 mark. Yeah, this is a psychological level now. Most investors are keeping an eye on. 0.11% higher yesterday. Volume value and deals, we see about 537 million. That was traded yesterday. So we might be seeing some confidence right there. Flip over to other parts of the market. Let's see what played out with some of the top trades yesterday. So we see top trades. Wemba Bank, 104.33 million traded. Deep Cap, back up there, 42 million traded. Zenith Bank, about 33.85 million traded yesterday. So looking at the top trades, Legend Internet, I do believe they have a recent partnership there with SpectraNet, and we see investors there buying up the stock. They're up 10%. Zik that's back again, at this point. It's been rising back to back, after they got the suspension got, lifted. And we see Premier Paints also featuring there. Fits in, that's in pharmaceuticals. That dropped about 9.97%. Austin Lars, 9.89%. We see Lotus Hall, they're 9.09%, one of the ETFs down yesterday. So that's majorly the picture. We'll see if this continues and we're able to hold on above the 200,000 level. That's for the local bourse. All right, let's get on to other stories now. Nigeria recorded a strong rebound in foreign capital inflows in the final quarter of 2025, with total importation rising to $6.44 billion. That's according to the National Bureau of Statistics. That represents a 26.6% increase year on year, signaling renewed investor confidence in the country's financial markets. Portfolio investments remained the dominant driver, accounting for over 85% of total inflows. There you have it, 5.49 billion. Hot money still getting most of the attention right there with capital importation. Other investments, we see banking sector again, that's leading. That's where most of the monies are flowing to. The banking sector, 59.75%. Financing sector, 30.15%. Production, manufacturing sector, which is where we would like to see most of the money, going into. That's capital importation. We're seeing that much lower. So there you have it. That's the picture right there for the fourth quarter. Capital imported into Nigeria. All right, let's look at other matters now. The central bank has directed international money transfer operators to open Naira settlement accounts with commercial banks in Nigeria, in a move aimed at strengthening the country's foreign exchange framework. Under the new requirements, IMTOs will be mandated to process transactions through local banking channels, ensuring that remittances are settled in Naira within the domestic financial system. The directive is scheduled to take effect from May the 1st. So definitely be keeping our eyes out for that one. Then Nigeria's federal government, they've opened subscriptions for 750 billion naira worth of bonds for March 2026 as it steps up domestic borrowing to fund its fiscal needs. According to Debt Management Office, the offer includes 3 reopened instruments maturing in 2030, 2032, and 2033, with coupon rates ranging between 17.9 to 19.9%. The bonds will be issued via a competitive auction where investors bid based on yield, while the coupon rates remain fixed under the reopening structure. The auction is set for March 30th, with settlement scheduled for April the 1st. And to other matters now in agriculture, the EU-Nigeria twinning project, they're looking at improving food security and food systems using climate-smart technologies, has officially been launched in Abuja. The project, which is funded by the European Union, aims to promote climate-smart agriculture and enhance value chain developments in Nigeria. I will see the Minister of State for Agriculture and Food Security, Mr. Abdullahi Sabi, says the project aligns perfectly with the federal government's national priorities of food security and export. The launch was attended by senior government officials, development partners, and private sector representatives. They emphasized the importance of strong partnerships and shared commitments to building resilient agriculture.
The EU-Nigeria twinning project being launched today aligns perfectly with these national priorities. Through this initiative, it is our hope that Nigeria will benefit from valuable technical expertise and knowledge exchange with European partners. And we welcome the partners so far that are here as we do this launch. The project will support the review of Nigeria's National Agricultural Resilience Framework and development of technical guidance on climate-smart agriculture techniques, with the aim of strengthening the policy environment and aligning it with international best practices. Equally important are the opportunities for capacity building and institutional strengthening that this project will provide through study visits, training programs, and technical exchanges. Nigerian experts will gain valuable exposures to global best practices in agricultural policy development and climate-smart technologies. These experiences will undoubtedly contribute to strengthening Nigeria's institutional capacity and policy implementation architecture. The Federal Ministry of Agriculture and Food Security remains fully committed to ensuring the successful implementation of this project. We will continue to work closely with the European Union delegation and the consortium partners to ensure that the objectives of these initiatives are achieved.
And for the commodities markets, Nigeria's refining ambitions are back in focus as the NNPC Limited is facing scrutiny over crude supply shortfalls to the Dangote refinery. The development raises fresh concerns about, feedstock security. Joining me now to unpack this, we have Dr. Foma Wokolos, the Vice President, Research at Financial Derivatives Company. Great to have you on the show, ma. Good morning.
Good morning, Laddie. Thank you for having me.
Fantastic. I don't know when last you bought fuel, but I bought yesterday, and yeah, it wasn't funny, at all, seeing how much I had to spend, to get, I couldn't even get full tank, at this point. And now we're talking about feedstock. What's really behind the crude supply gap, from the NNPC Limited, to the Dangote refinery? Is it production constraints, commercial disagreements, or policy misalignment? What are we dealing with here?
So I'll say that what we are seeing right now, what is playing out is not policy disagreement or whatever. I think it's production constraint, because after the agreement was reached for a Naira for crude deal between Dangote and NNPC have not been able to meet up with the commitment. And between October, I think 2025, and mid-March, we have a shortfall of about a quarter of the requirements. They have been able to provide like a quarter of the requirement, having a shortfall of over 74%. So I think what is playing out here is the production constraint one. Also, that crude oil is pre-sold. We have like a forward sales. If NNPC had done like a forward sales to in the international market before now, it's going to affect its supply to Dangote. Then also another thing is the creeks economics. Of course, we know we cannot rule that out. The creeks economy simply means an illegal activity within the production of this crude oil. So once the price of oil becomes high, like we're seeing the global market selling for 100 and something, so the creeks economy, they make more money. So it's an incentive for more thefts and vandalization. Like we saw in January, production rose to about 1.4 million barrels per day. And in February, we are seeing a different story. It declined to a 1.3 million barrels per day. So that's a huge decline. And this is only because of the, I call it creeks economics going on right there. Of course, when oil prices were lower, the activities will be lower because per liter, let's say for instance, in the creeks economy, a barrel of a liter, how do I put it? Oil price could be sold for, the vandalized or stolen oil could be sold for as low as $30 per barrel. But once there's an increase, you see that the margin will also increase. They can be going for like $80 per barrel. So this will give them incentive to even steal more and to vandalize more. So production becomes low. And I think that's where NNPC is having the challenge to supply Dangote as much as it needs. So what Dangote is doing presently is to augment for oil from outside, that is import. And once the import, this is also feeding into the price of PMS that we are seeing today. Like you mentioned earlier, getting a liter of PMS right now is well above 1,300 naira that we see. And also diesel is well over 1,800 naira. So it's really choking right now. And I think it's a production constraint.
Yeah, I guess at this point, the right balance to say is he choke at this point. All right, so definitely when we heard about the crude for Naira deal, most of us in our minds, okay, fantastic, this is what we need, at this point. He doesn't need to go and source dollar. That's the Dangote refinery, does not need to go and source dollar. So we expected there won't be issues, when it comes to getting feedstock, as long as you can pay for it in Naira. But what we're seeing now is they cannot supply the refinery with the oil that it needs, at this point. So I guess that takes us back to the basics at this point. They have to import to augment the feedstock, at this point. Exactly. So that means they have to go and source dollar to make this happen. They have to go to the international market. So we're back at square one, at this point. Exactly. So what are we seeing? What are you expecting going forward? Because this is definitely going to impact inflation. Everyone's bracing for inflation numbers for March. And I'm sure you already have your projections, at this point. What are you seeing?
Well, I'll say that the Naira for crude deal was, we looked forward to it thinking that it's going to be a deal that is sustainable. But from what we are seeing, if you see Naira has continued to depreciate. And I think there's much pressure in the FX market right now because people are sourcing for dollar for importation. And the gross reserve has also continued to decline, is below $50 billion as we speak. So I think the CBN is trying to cushion this effect. And we have a buffer as it is. I don't think that the Naira is going to fall off the cliff because we have enough buffer from the CBN. But be it as it may, the consequences is that we are going to see inflationary pressure in the month of March going forward. And it's not particular to Nigeria alone. Every country is experiencing this squeeze that we are seeing. And I know that is going to impact more. It's going to have a cascading effect on the economy, even though the government is getting the revenue because of the increase. But let's not forget that if government has done like a pre-sold before now, the oil hike, we are going to be out of the revenue. But if government is doing its sales right now, we are going to be in the revenue. But however, inflation numbers are going to spike. If you look at inflation token factors, you see that they are beginning to reverse themselves upward, which is one of them is the PMS price. It's gone up over 60%. And then transportation fare too have gone up over 33%. So, and this will impact logistic costs. And what logistic costs is impacted, inflation is imminent. So we are waiting for March inflation numbers. It will be well above 15%. I think that is what we should be expecting.
We're all expecting it to be a dramatic number. That's the March inflation number. But definitely, once inflation goes up, I guess what we expect from the MPC is to hike rates. At this point to rein in inflation. But I'm wondering what to do. At this point when you see this inflation is being stoked by energy prices, and you come in there again and raise rates, that looks like it's not the right move, at this point to increase interest rates. What do you think the MPC or most of these central bankers, what else do they have?
Yes, it's not particular to Nigerian CBN alone. Central banks globally, even Bank of England held rates, Fed Reserve held rates, banks are holding rates, and some are even increasing interest rate. The only measure that the CBN can use to curb inflation is by mopping up liquidity. And they can do that by increasing treasury bills so that people can invest. It can be through increasing the CRR so that we have lesser money in circulation. It can be through sales of OMO, which you just mentioned earlier. It can also be through interest rate hike. But before the CBN will decide to do a hike, it will first of all look at the trend of inflation. The next meeting will be in May. So we have March inflation, April inflation. So once they see the trend, if the trend continues, and I think they may decide to hike interest rates. And I think we may now, the fiscal policy may now come in at this point. So we may have there should be a handshake between the monetary and fiscal policy, because monetary policy alone cannot do this. A fiscal policy should be there to cushion the effect of the monetary policy on the masses and on the economy. So a policy hike is dependent of these two rates that we are expecting, inflation rates that we're expecting for March and for April. Then for May, we'll wait to see what the MPC decision will be.
I guess at this point, if fiscal policy doesn't work, monetary policy doesn't work, maybe we'll look for spiritual policy at this point. Well, thank you so much. It was great having you, Dr. Ifeoma Nwokolo, Vice President, Head of Research, Financial Derivatives Company. Thank you for coming on today.
Thank you for having me, Ladi.
All right, we'll take a break now. When we come back, definitely navigating this market's not easy. Where do you invest, at this point? That's next on Business Morning. Just stay with us. Right, I see markets these days, they're having big swings with the Iran war, and mostly what we expected to be safe haven sometimes turns out to be even more volatile, than risk assets. So you wonder, is it risk on or risk off? Where do you go, in this kind of market? So now we're going to analyze some of the stock picks from AfriInvest Research. They're going to help us. They've done all the research at this point, and they'll give us direction in what to look out for, in this market. Stocks to watch right here in the Nigerian market. Joining for this now, we have Nathaniel Disu, who's an investment research analyst, AfriInvest West Africa, and he joins me right here in the studio. It's great to have you. Good morning.
Yeah, good morning, Ladi.
I can imagine, What's it like, with research guys, when you're seeing what's playing out so far, in these markets, you see the war in Iran, we didn't expect it to happen. It came and we're seeing markets already gyrating, to what's playing out. How does it affect you guys, your daily lives, at this point first?
Well, it can be a struggle, to be honest, because especially when you look at the global macro situation, just like what we talked about in the US-Iran crisis and the likes, especially when it relates to the crude oil price, you can see a lot of volatility swings. Today, crude oil price will be over $100. Tomorrow, Trump will tweet something, it will be less than 90 something. So that can also weigh into decision making. So it's not quite easy, but we have to do our job.
And I'm sure you guys have done your research. You already have a plan, for 2026 for some, sectors. You're expecting maybe consumer goods will outperform. Then this happens, then you have to go back to the drawing board and say, you know what, okay, I guess this plan is not going to work. We have to pivot to something else. But let's look at your latest stock picks now. For the banking sector, you've seen the likes of Access Corp, Fidelity Bank, First Holdco, Stanbic. So what you're seeing there is the forecast from AfroInvest. They see Access Corp could rise 89.1%. That's for 2026. Yeah, Fidelity Bank, you're seeing about 82% upside potential. First Holdco, 29% upside potential. But to Stanbic, you're seeing a downside potential there of 21.6%. But let's start off with this big one here, Access Corp. What are you seeing that we're not seeing that could take Access Corp this high?
So for Access, it goes beyond the 12 months target. So it's more like a long-term play, because looking at Access Corp, it still remains the largest, largest lender in terms of assets size and the like. So, and Access historically do a lot of acquisitions and the like. So we expect that to play out in the long term. So it's more of a long-term plan beyond just the 12 months target. So that's what we are seeing for Access. So for Fidelity also, when you look at Fidelity is an interesting case, because if you look at the tier 1 lenders and look at the tier 2, amongst the tier 2, Fidelity tends to be like the outperforming company, or let's say bank in that space. If you look at the asset size, they are kind of punching way higher. So we expect a lot of upside in Fidelity Bank. And also Fidelity has an international banking license, and they've also met their CBN recapitalization mandate, and likely with virtually all listed banks. We've seen, I think last time I checked the data as of 24, that was like yesterday or 2 days ago, over 30 banks have met that threshold. So we see a lot of renewed investments, investor sentiments in the banking sector. We see a lot of confidence in that sector, and that's why we are optimistic on the banks.
Then, for downside, you're saying Stanbic could be down 21.6%. And, I did look at the data, the capital importation data for Q4 2025. As usual, the banking sector got most of the funds, as usual.
Everybody loves banks.
This why everybody loves banks, and it's sad to see, the manufacturing side of things, getting, the short end, obviously when it comes to capital importation. So talk to me about Stanbic, 21.6% downside. What are we seeing there?
So for Stanbic, it's more of just price movement, basically. And like I said earlier on, in terms of the recapitalization, they say that all banks have met that threshold. But when it comes to target price picking, at times when you put your target price, a stock jumps way above that price, and it's not every day you tend to change your target price. So that's one of the things that we are seeing in Stanbic. But it doesn't mean Stanbic is not a good
So
thing.
if you look at the banking sector, definitely we have a lot of positives, there on that chart. But for consumer goods, that's the next one. Just one, and that's Nigerian Breweries, has the upside potential of about 17.2%. But we're seeing red, for the rest. The likes of Boer Foods, we're seeing downside potential of 36.7%. Dante Sugar, 50 point, that's huge, 50.7% downside potential. So I'm wondering, is this connected with what we're seeing play out with the Iran war?
So for consumer goods, interestingly, last year was kind of a recovery phase for the consumer goods sector. In 2023, when the FX liberalization happened, consumer goods and other manufacturing-based companies, they tend to suffer because of the impact of the FX losses. But in 2025, we saw most of the consumer goods companies recover, and we expect that recovery to also play out in 2026. And beyond just that, apart from that, even the stock recommendation on Afriva is an interactive stock, so it gets updated real time. So currently there are other stocks within that consumer goods bracket that are also positive. We see NASCON is there, and just like I said earlier on, there are some stocks that after the target price peaking, it tends to overshoot. Like Nestle, for example, is just -3%. Unilever is just -2%. So it's still not. But for Boa Foods and Dank Sugar, especially Dank Sugar, I think what we are saying is that apart from other, like I said, most consumer goods companies have recovered in terms of their bottom line, but Dank Sugar is still in the red. So that's still something that is still playing out in that company. But if you look at the FX losses, it has minimized. As I think 2024, the FX losses was over 300 billion. Now it's about 100 billion thereabouts, going lower. So we expect more recovery to happen in Dank Sugar. So when the data feeds into what we project, they are going to be changing.
And definitely, to our viewers, definitely this is not investment advice. This is not financial advice. These are recommendations. It could happen, could not happen, but this is based on, research. But, generally, looking at consumer goods, you did mention, coming from a place of recovery, at this point. Before now, it was FX losses. You see their overheads, shooting up. But now I'm looking at what's playing out with the energy crisis, at this point. Everyone's paying so much now for fuel, for diesel. At this point, I'm guessing this might impact them negatively when we see those earnings for 2026.
So for consumer goods, if you look at Boa Foods, for example, in their unaudited figures, their revenue was 1.8 trillion. But if you look at their cost, it's 1.1 trillion. And this is the first time they would cross the 1 trillion threshold in terms of cost. But if you look at their bottom line, it's over 500 billion. So one of the things that we see, particularly in that company, that they are able to pass on the cost onto consumers. And that's one of the things consumer goods companies tend to do. Maybe that's why they're even consumers. So they tend to pass on that extra cost. And even for the brewery companies, we still see that same thing happen. It's easier for them to pass on. And with the whole Iran crisis happening, fuel costs, diesel costs rising, we are expected, especially for Q1, we are likely to see a spike in their cost because but at the end of the day, they will still be able to pass on. Especially for the brewery stocks, 2026 is an amazing year. For example, we would have the World Cup in June, and due to it happening in different time zones, North America. So it's going to happen lately around that ninth period in Nigeria. So there are going to be a lot of activity from football.
Okay, the guys that like to drink
so
and
that
watch
would
football,
also weigh in into their revenue. And it's a pre-election year, there's going to be a lot of activity. So we expect more demand for the brewery stocks, and that would overall play out in the consumer goods sector.
All right, definitely a lot to unpack there. But, generally, I keep saying this, being an investor right now is no easy task. It almost seems you might be safer just being in cash, at this point. But definitely we have that animal spirit. Some of us just believe there should be a way I can turn 10 naira into 50 naira, regardless of what's playing out so far. What's the philosophy navigating this 2026 in your opinion?
There are still opportunities available in the stock market generally. If you look at the consumer goods, the oil and gas sector, oil and gas is the best performing sector on the NGX so far. As of yesterday, the oil share index has gained about 29% thereabout, but the oil and gas sector has done over 60%. So there are still opportunities there, and one of the drivers of that rise is Aradel and Seplat. Aradel alone has gained over 80% year to date, while Seplat, I think about 50-something% year to date, and we weigh in the market capitalization and the like. So that is still an opportunity in that sector. There's still a lot of opportunities, even in the banking sector. Looking at Zenith Bank, for example, Zenith Bank has done, I think, over 60% or 70% year to date so far. GT has done over 50%. So there's still a lot of opportunities within this sector. So it's more of you getting the right advice, the right ideal research recommendation, and
that's what shocks me about major markets at this point. In the midst of all of that fire, all of that confusion, in the market, you're running away from it, saying, you know what, this volatility is too much for me. But you now listen to or check the performances of some of these asset classes, and you see that they're up 50%.
Yeah, all the
less.
asset class is not going to, get affected negatively, except if you have a kind of a COVID disruption that happened 6 years ago. But the Iran crisis is even weighing in positively for the oil and gas sector. If you look at it, and also on the NGX as a whole, January did about 6.3%, February did about 16%. That was like the peak so far. While March is more of like profit taking, around 4% thereabouts month to date. So there's still a lot of opportunities despite the gloom, because whenever there are crises or this kind, it's not all sectors that is going to be affected.
Right.
Gold, for example, has done amazing well this year.
Yeah.
So when you
coming in from 2025,
exactly,
but
so there are
a lot of volatility right there with gold.
So that's why you need to play your cards well.
Fantastic. Yeah. Thank you so much, Nathaniel Disu, investment research analyst, AfriInvest West Africa. Thank you for giving us some direction this morning.
Yeah, thank you, Ladi.
Thank you. All right, some other news now. We've seen trade between Nigeria and Germany currently hovering at 3 billion euros. See, there's significant room to scale up by tapping into the dormant potential of both nations. Germany's Consul General in Lagos, Daniel Kroll, made the assertion as German businesses visited the consulate following the 11th International Agro-Food Trade Show and Conference. The exhibition featured 14 German firms among 137 participating companies from 17 countries.
I think it's fair to say that it's not a big significant number of food exports from Nigeria to Europe or Germany, and it's certainly way below potential. And of course, we all know it's partly because of security reasons that farmers are afraid of farming, and that is limiting the capacity. But I think it's more important about why do I have to buy, if I go to a supermarket, why do I buy tomatoes from China? Yeah. In a country like Nigeria, where tomatoes grow everywhere. I was 4 years Germany's ambassador to Ghana, the same problem. These companies here would enable Nigerian investors in their own country to create jobs and future and opportunities for the young Nigerian population. And we all know the population is growing. So expanding the capacity to produce food items is essential for Nigeria's future.
So currently we have 90 German companies operating in Nigeria. There were more, but currently it's 90, and I know that it's growing. We currently have a lot of interest in Nigerian businesses joining the chamber as a result of this. You know that the German brand is very good, and so you'll be getting quality. And likewise, we're also getting interest from Germany, asking us about companies that they would like to do business with. And the good thing about joining the chamber is that the chamber can validate a company, it does its due diligence on companies. So when we get requests, we're able to recommend members of our chamber.
All right, let's talk AI now. Artificial intelligence is not just transforming how businesses operate, it's now reshaping how they buy technology. Globally, companies are beginning to move away from long-term software contracts that once locked them in for years. Instead, they're demanding shorter, more flexible deals driven by the rapid pace of AI innovation and the fear of being stuck with outdated systems. This shift could have major implications from how global tech firms do business in Nigeria to how local startups compete and scale. Joining me for this conversation now, we have Mr. Tumi Akande is Associate Director, Tech Platforms, KPMG, West Africa. Good morning. Great to have you.
Good morning. How are you doing today?
I'm doing great. So, it's quite interesting seeing what's playing out right now with, SaaS, that's software as a service, and the disruption is getting from, artificial intelligence at this point with, companies globally, cutting their long-term obligations they normally have to some of these, software companies. Talk to me about what's playing out so far. Do you think these firms, these global firms, are becoming too reactive, to the AI trends?
I mean, that's a good question. I wouldn't necessarily call it reactive. What we've seen is what I'll tag as strategic adaptation, especially in this side of the world, Africa and then Nigeria as a whole. In fact, there's a recent study that KPMG carried out, and we've noticed that over 70% of organizations in our continent are already thinking about artificial intelligence and how to adapt that into their business functions, right? Of course, the SME is a different, that's a different ballgame entirely. For small and medium enterprises, for them, it's really they have no options right now but to start thinking consciously about how to infuse artificial intelligence into the key aspect of their businesses, sales, finance, and the likes. So it's we're not reacting, we are responding and adapting strategically.
Yeah,
that's what research shows.
Yeah, it's quite interesting. Seeing the way some of these software stocks were impacted earlier, due to AI disruption there. And looking at the shift we're seeing so far when it comes to some of these contracts, contracts are shifting from 3 to 5 years to about 6 to 18 months. That, some of these long-term contracts that these businesses have, with these software companies, we're seeing rise of pay-as-you-use, AI pricing. Up to 70% of companies reviewing contracts due to artificial intelligence. Enterprise tools are now updated monthly and not yearly. And we know the key players driving the shift there: OpenAI, Microsoft, Google. And definitely this still boils down to importing technology at this point. What do you think local startups can do to plug in here, try to get some business out of this?
I mean, I think you've actually said it all. These are the big boys in this field. And if you look at what they are doing, think between them this year and maybe some other players that are not listed here, for just 2026, about 650 billion is set aside to play in this field. So can local startups play that capital game? The answer is no. However, if we look at the entire artificial intelligence stack, take a bird's eye view, you see that there are 4 major components. There's infrastructure, which is where these players, hyperscalers, are investing aggressively. There's the model itself, which is the real logic, is the algorithm running behind the scene. And then we have data. And lastly, applications or business solutions. So where local players can thrive is the data, because then we have the local nuances. We understand the local terrain, right? For example, data around our languages. How do you translate? How do you leverage artificial intelligence to speak Hausa, Yoruba, or any other language around us? And then certainly business applications where the local players are building for the local market, solving local problems. If we approach it that way, yes, we can compete really favorably. But playing the capital game where we have to churn out 650 billion for infrastructure and compute, at this point, I'm not sure, and I don't believe we're ready for that particular phase of the game.
Yeah, it's quite interesting seeing the amount of money some of these companies are spending on, developing AI, at this point, and the infrastructure. But, looking at some of these companies shifting from, long-term contracts to short-term contracts. Does short-term contracting, does it reduce costs, or is it something that increases costs over time?
It's a balance. I would say it's a fine balance that has to be, and it's a journey to run very carefully also. For large corporations, what we will see is that large corporates have to think about it really strategically. If they look at the entire IT landscape, a portion of it is changing really rapidly because of the rate of innovation, especially around artificial intelligence. However, there are still some stable portions that have been around for a long time. So it's a balance, and what needs to be done is the part that is not changing too often should be maintained. The portion that is changing rapidly, that one, like you mentioned earlier in one of the slides you showed, they can go for shorter contract life cycle. However, the more stable portions can stay. For SME, it's slightly different though, because they may not necessarily have the capital to even use for long-term commitments. So what they need to do is look carefully at what their business, the key aspects of their business, finance, sales, customer support and customer experience, and any other key functions they might have, and look at how they can infuse short-term contracts, how they can leverage that to boost operational efficiency, time to market. So that's how I would, that's the best way right now to approach it.
All right, and I'm
there's
talking
no
about
one size that fits all.
Yeah, I'm talking about the best way, to approach it. Do you think there's some kind of balance, businesses should, adopt, when it comes to, being flexible with some of these, with a long-term strategy? Do you think there's a better way to do it? Because I'm just imagining I'm a business right now. I don't want to get, stuck in a contract for, 5 years.
Yeah.
So I say, you know what, I'll just do a few months. But what if that technology is not meeting my expectations somehow, or it was meeting my expectation previously, but it's not meeting it anymore, and now I have this short-term obligation with, some of these, software platforms? How do I balance this, really?
Good question. There's a good balance, right? The first one will start from how you even train the workforce. It has around artificial intelligence, that is, right? It's no longer the nice to have. Every organization that wants to build for the future needs to be very conscious about the workforce strategy and how artificial intelligence can augment what they presently do. That will be the first one. That is the foundation for the balance we're trying to create. On the other hand, for larger organization, identify the aspect of the business that really needs to transform rapidly, right? And those are the ones that we can leverage some of these short-term contracts for, artificial intelligence contract for. As you mentioned earlier, innovation is changing rapidly, right? So you don't necessarily want to get stuck. Neither do you also want to get locked into a particular vendor. So technologies that will be adopted need to be open, right? Need proper roadmap that builds for the future. And then you think about how do you integrate this into your business. Of course, as I mentioned earlier, the other balance is there are certain aspects of technology that have been around for a while and will continue to be stable, right? Some of the core system will be stable. If it's a bank now, they won't just change their core banking because AI is here, right? However, the way they engage their customers, if it's an energy company, a power, a disco, the way they engage their companies, their customers rather, they can be really innovative around that and leverage some of the short-term contracts for that. But the balance needs to be looked at really carefully. Proper introspection is necessary.
Right, and definitely we've already seen the reactions in major markets at this point when it comes to some of these software companies. Their share prices have dropped a lot, with the AI disruption. so far, or what major analysts are seeing would be a big disruption for their business going forward. But how are you seeing this disruption going forward? Is this something that might not really happen in the future? Talking about AI disrupting software as a service.
It's here to stay. It's here to stay. The same way the internet disrupted businesses in the late 90s, early 2000s, is the same way artificial intelligence will disrupt businesses tremendously, such that organizations that are not thinking about it might get outpaced significantly by organizations that are leveraging artificial intelligence to boost operational efficiency, time to market, and productivity. So it's here to stay. Businesses need to start looking at it seriously.
Fantastic. Thank you so much. That's a good place to leave it. We talked to Mr. Atumi Akinade, is Associate Director, Tech Platforms at KPMG West Africa. Thanks so much for coming on today.
Thank you very much for having me.
Thank you. All right, still looking at trade now, as Nigeria and the United Kingdom look to translate recent high-level engagements into tangible business outcomes. Attention is turning to the private sector to drive that momentum. At the Nigeria-British Chamber of Commerce trade mission in Essex, our correspondent Juliana Olayinka spoke with Adam Golding, operations manager at Shelburne Reynolds, on how UK firms are positioning for opportunities in the country. Take a listen.
We are an agricultural company. We're based in East Anglia, just Suffolk, Essex kind of area. We make agricultural equipment that we use across the world, exporting to many countries, US, Africa, Far East. So yeah, that's what we do. Successful, I think, is looking at other links and to other markets that we're looking to. The world is in turmoil at the moment, and we're looking to beyond traditional markets that we've exported in over the last 25 years, and we're looking for other opportunities to make links with emerging markets like Nigeria, and to see if there is some kind of synergies there that we can utilise and use a bit more in the future. Yes, I underestimated how big Nigeria, the economy is, and the influence in Africa in areas. So yes, it's exciting to kind of start these links and start to see where these markets kind of emerge and go to.
All right, let's find out what's playing out in the global economy. We have Will Ibong with the details.
Thank you, Ladi. Let's begin with market reaction Wednesday in the U.S. after Iran publicly rejected the U.S. ceasefire offer, instead countering it with its own 5-point list that would give Tehran control over the Strait of Hormuz. Here's our U.S. correspondent, Maria Bird, with the highlights.
Showed some positive signs on Wednesday as the Dow Jones was up at 0.6%, the S&P 500 was also up at 0.5%, and the heavy tech Nasdaq took the day at 0.7% up, as many investors were watching to see what the U.S. did with its plans around Iran. As it's clear that the president says he's made a proposal to try to halt fighting in the near future. This plan has not yet been fully accepted by Iran, but investors are hopeful that we could see a decrease in violence in the region over the next few days or weeks ahead.
Oh, thank you, Maria. Now we see a Turkish oil tanker carrying crude has reported a suspected attack in the Black Sea, raising fresh concerns over maritime security. Now, according to Turkish authorities, the vessel signaled a possible undersea strike, though no injuries or oil spill were immediately reported. Now, up next, U.S. President Donald Trump has criticized the U.S. Supreme Court following a ruling that struck down his sweeping tariffs, targeting 2 of his own appointees. Trump singled out Justices Amy Coney Barrett and Neil Gorsuch for backing the majority decision, which found his use of emergency powers to impose tariffs was unlawful. Now we'll move to Europe. Germany is drafting plans to target American companies in response to potential future trade conflicts with Donald Trump. Officials are working on measures aimed at strengthening Europe's response if Washington imposes new tariffs or economic pressures on allies. The move comes amid rising transatlantic tensions, with Europe signaling it is ready to push back against U.S. trade policies and avoid being caught off guard in any renewed tariff disputes. Now we see next, Elon Musk is asking for a judge in Delaware to step aside from ongoing shareholder lawsuits, citing concerns over bias involving Tesla. Lawyers for Tesla filed a motion urging Chancellor Caitlin McCormick of the Delaware Court of Chancery to recuse herself, alleging potential partiality. The lawsuit, we see, centers on shareholder challenges to Musk's multi-billion-dollar pay package at Tesla, with investors arguing the compensation was excessive and improperly approved. We see next, the Philippine Central Bank has kept its benchmark interest rate unchanged at 4.25% in an off-cycle decision, signaling a cautious stance on monetary policy. The move comes after a series of rate cuts earlier this year, with policymakers opting to pause as they assess inflation and economic conditions. We see former Thai Prime Minister Srettha Thavisin is calling for the country's debt ceiling to be raised to 80% of GDP to help revive economic growth. Srettha says lifting the limits would give the government more room to spend on infrastructure and support programs amid slowing growth and external headwinds. And still in Asia, China's Shaching Memory Technologies is ramping up production of high-bandwidth memory HBM, aiming to compete with Samsung, SK Hynix, and Micron. The move comes amid soaring global demand for AI chips and tightening supply of advanced memory critical for data centers and next-gen computing. And those are
Thank you so much, Will. And, looking at most of the markets at this point, we see the NGX still holding on as a pre-trade, holding on to that 200,000 level. Oil definitely still up, and that's what's driving most indexes down at this time. We see gold, that's down. The dollar index, safe haven trade at this point. When you see gold going down, that's looking up at this time. Bitcoin struggling, falling below the $70,000 level, and definitely investors are looking out for next comments on maybe some kind of de-escalation when it comes to the war in Iran. But right now, the markets are seeing and pricing in escalation, and that's where we're seeing indexes are under pressure right now as oil resumes the rise. We'll bring you more updates on Business Incorporated. That's at 1:30 p.m. To bring you up to speed, to get direction on where to place money at this point. Is it better to be in cash or try to just navigate some of these volatile markets? Definitely that choice is yours. Thanks for watching Business Morning this morning. I'm Ladi Williams. From me and the team right here at Channels HQ. It's bye for now.